My name is Michael Dean, co-founder at AgFunder. For those of you who have never heard of AgFunder, we're an online investment platform for innovation in food and agriculture technology. Our business comprises an investment arm where people can log on, go onto our platform and invest in the opportunities that we profile on the platform, and also a research and a publishing arm as well. We started out as a crowdfunding platform and very quickly realised that we were very good at identifying good quality early stage ag and food tech opportunities. The problem with that, though, was that we weren't capturing any of the value we were creating. We were attracting a lot of investment for these companies, but we weren't investing ourselves. So we've decided to do a bit of a pivot, and we've launched our first venture fund, and we're going to be investing ourselves in every company that we bring onto the platform. Since we launched our first fundraising campaign for companies on the platform, we've reviewed over 3,000 opportunities. We've helped those companies that we've listed on the platform raise over $35,000, and we have now over 32,000 members on the platform, and that's growing by around about 1,200 a month. So things are starting to take off. Ag tech is starting to get a bit of traction in the market, and it's really starting to be seen as a real destination for investment capital. We've got over 4,000 accredited and institutional investors on the platform, which sort of underlines what I just said, with more than $10 billion of investable capital from 80 countries. AgFunder News, if you haven't registered for AgFunder News and you're not subscribing, please do, because it's really the go-to place for finding out exactly what's happening on in the sector, what's happening in technology, investment, and also development in the technology sphere. We publish research as well. We do research. We've released research in the last 6 months with Boston Consulting Group. I'll touch a little bit on that later on. And also our own investment reports that we publish twice yearly, mid-year and end-of-year reports. And our last end-of-year report, 2016, is what I'm going to be mainly focusing on today. So that's AgFunder and AgFunder News. I went to. So some top-line figures. $3.23 billion was invested in ag tech last year. Not a great result given the record we had in 2015. We saw about a 30% decline in investment last year. But given the record levels that we saw, which was 4.2 billion in 2015, it's not surprising that we saw a bit of a pullback. I'll talk a little bit about the reasons for that going forward. There's a 10% increase in opportunities that were funded, which is a positive, and they mainly came in the earlier stages in seed and Series A. So this slide shows total investment size and number of opportunities. The green bars are the amount of money that was invested, and the yellow lines are the number of opportunities that were funded. If you look over here to the Q4 2016, you can see there was a substantial drop. Totals were down all year, but we saw really Q4 decline for the first time since 2012. In 2013, Monsanto purchased Climate Corp, which was really the kickoff of ag tech being a real destination for investment. And then we saw in 2014 that sort of following on and growing, and then reaching 2015, you can see those record levels there. The drop-off in Q4 was really surprising to us because, although the figures were down during the year, it was the first year since 2012 where we'd seen Q4 be the lowest figure for investment capital. Up until then, the end of the year had always been sort of a rush. After the summer in the North American summer, we normally find that investors come back and they're ready to go, but it didn't happen last year. And that followed through into the broader technology market as well, where consumer tech, all sorts of tech, was down roughly 24% for the year. So ag tech was tracking with the general consumer tech investment market as well. Reasons for this: we think the political uncertainty around pre- and post-Brexit, along with, of course, the election of Donald Trump late last year, the lead up to the general election in the US saw a lot of activity slow just because no one knew what was going to happen. So one of the interesting things here is you can see, as far as the number of opportunities here, the impact that sustained investment has on innovation. So if you track the funding that is going across 2014, 2015, and the number of opportunities or deals, as we call them, that are emerging into the market, it's clear that sustained, continued investment in technology attracts talent and attracts ideas. That's going to be a crucial component for Australia moving forward, and we're moving in the right direction. But it's just something to bear in mind that, you know, the government, the people that are leading us, need to understand that investment in technology is only going to pay back in spades. Investing in more coal mines is not going to do it. We need to be developing ourselves as an intelligent society. Okay, so this is showing investment by category across 2014 to 2016. You know, it's obviously there that food e-commerce took up the bulk of investment across the entire period. And a lot of criticism for including food e-commerce in our reports. We've always said that we were going to include technology across the food and agriculture value chain. And, you know, the litmus test for us as to whether a technology is going to have an impact either upstream or downstream across the value chain. And clearly that food e-commerce and these delivered meals packages do. In the US, we're already seeing some of the bigger players are contracting directly with growers and producers for their meal packets, for their meal packages that they deliver. So that's clearly impacting on the food, how we purchase and acquire our food. And we're going to see that moving into new markets as well. There were high-profile failures in this sector, which really makes it surprising that we saw so much investment. With a delivery model, it's obviously very, very important that you get your unit economics right. And you know, there was literally half a dozen, maybe more, that went under last year. So despite that, food e-commerce still dominated the investment sector. We saw a lot of investment in China, some European opportunities got some big money, and also a couple of European, US-based companies. So they accounted for 40% of the total funding, 1.29 billion investment dollars. There's 5 individual deals over $100 million each, and having that access to broader consumers, a broader consumer market, is why they're attracting so much attention. One of the problems with ag tech is obviously adoption of technology, getting the technology into the producer's hands. When you've got an aspect of your business that is servicing a broader consumer base, you're going to attract more capital, because that's what the venture capitalists like to see, traction. Ag biotechnology startups came in second. They captured 22% of the funding, and at that level it was $719 million across 84 companies. Crop technologies developed really dominated that category, 523 million of that across 61 deals. Of those, 22 were researching the microbiome for biological products. So soil health is going to be a key aspect moving forward. We'll see a lot more investment in soil health and the microbiome moving forward, in my view. 3 of those were using gene editing technologies as well. 21 technologies focused on animal agriculture, raising $177 million, and 9 startups raised funding utilising waste of some kind, and waste is another area that's going to be growing in our view. Investment in precision agriculture technologies, which is sort of data capturing devices, sensors, farm management software. They saw a real pullback last year, down by 39% on 2015. So that sector had become a little bit overheated. There was a lot of operators in the sector that were competing. We're starting to see some consolidation there, and a few fall by the wayside. So we expect that that decline to continue through this year. A big part of that drop was drone technologies. Investment in drone technologies dropped by 68% last year. Partly as a result of heat around the market, but also because we saw a number of drone companies split out and start to do different sections in the technology stack, whether that be the drone operations, or whether it be the analytics, whether it be computer vision, those types of things. Companies that were doing all of them before are now starting to split out and focus on one particular aspect. Right, this is deal volume and activity by stage. So you can see seed stage investments for sheer numbers continue to dominate. In 2016, accounting for 57% of all investment across the sectors at 217 million on 337 deals. 16% increase in the number of companies that were funded, but a massive 77% increase in the amount of money that was invested, 230 million as opposed to 120 in 2015. Quite interestingly, AgTech bucked the global VC trend, which saw seed stage deals really decline last year. So that general consumer tech, seed stage, early stage companies, investors in the general tech arena were sitting back and waiting for them to mature, instead investing their money in more mature opportunities. Series A funding contracted in 2016 as opposed to 2015. Investor caution, there was some pushback around valuations. Valuations got a little bit overheated in 2015, as you can imagine, with the amount of money that was being invested. And as a result, we saw Series A's decline and pull back a little bit. There was some maturing in the sector during the year. Startups at Series B stage actually raised $791 million, which was 14 more than the year before. And that was nearly double the number of deals of the year before as well. In contrast to Series A dollars in 2015 outperformed Series B in 2015. So, here looking at global distribution of investment. US, when we started looking at the US, obviously our data has matured and the amount of data that we're getting has improved dramatically. But in 2014, as we tracked it, 90% of AgTech startups were based in the US. Last year it was 58%, almost 60%. This year is below 50%, 48%. So there is more activity, notwithstanding that we're getting more data from other places. There is definitely more activity in AgTech occurring elsewhere in the world other than just the North American market. North American market is obviously the key market there. But things are happening elsewhere. The top investment destinations remain unchanged. US, India, Canada, the UK and Israel were the key investment destinations for AgTech technology. Here in Australia, we had a better year than we did in 2015. 2015 was pretty appalling. 2016 wasn't great, but it was better. We saw 7.15 million invested across 5 deals, and that was led by the Yields seed round and also AgriWeb, who did very, very well. Given the importance of agriculture to our national psyche and to our economy, we need to be doing more, frankly. So, overall, we see that there's a pretty substantial drop-off, but things aren't all doom and gloom. We haven't started aggregating our figures for this year yet, but all indications are that we're tracking well above last year for both deals and funds invested. We think that the emergence of a lot of accelerators that are working in the sector, the AgTech sector, are really helping to feed into that development. We're seeing a lot more early stage deals, getting some funding, getting some traction, getting into the hands of producers, and of course being able to prove out their model and start to develop their product and really go to market with something that's going to be worthwhile to farmers and really solve problems that need fixing. So this year's investments, 2017 I'm talking about early stage, have been driven a lot by some Series B, so some more mature investments. The Series A that we saw so strong in 2015 led on to seed being very strong 2016, so we're expecting to see Series B as these companies mature really perform well this year. We've seen a couple of exits with Australia's Observant being purchased by Jain Engineering. So, you know, there's positive movement on the field, and we're going to need a lot more of that consolidation and acquisition, and I'll talk a bit about that in a second. So where is all of this going? Traditionally, agriculture has been a very fragmented market and a difficult market to invest in. And that was sort of the thesis behind AgFunder when we started. We wanted to try and form a central place for people to come and identify opportunities to invest in and actually give them access to that. We've still got a long way to go. You have to be an accredited investor to invest in AgFunder, and that means you've got to be rich, essentially. So we're doing our best to try and democratise that process so that everybody, mums and dads, can invest in technology that they find interesting. We think that's the way it's going to go, but we're not there yet. Okay, I've been given the 5-minute warning. So we think that there is a lot of legs in agtech. You can see here, McKinsey did a report in 2015, the end of 2015, called Digital America. And it's a busy chart, I'm sorry, but if you can see right down the bottom, agriculture is listed alongside hunting, quite amusingly, as the least digitised industry on the planet, or in America. And given the Americans are sort of leading the charge, I'd say this is agriculture in general. So we see a massive opportunity, but why now? Well, all those technologies that you see up there are starting to make an impact in agriculture. We've got problems in Australia, obviously, with connectivity. SkyMuster's doing a bit to help that, as I understand it, but not enough. We still need to be able to get data from machinery up to the cloud and down into the farmer's hands in real time so that they know what's going on, rather than at the end of every day or the end of every 2 days if they remember. But the application of digital and other technologies developed for other sectors are moving into the agriculture sector. Because of these trends, we wondered how the big corporates were looking at this, and as a result of that, we did a report with BCG last year that was very, very interesting. I just want to share a little bit with you quickly. So it speaks for itself. 46% of the top agriculture executives in the big companies globally identified big data and analytics as a top priority. Other investment in focuses, obviously food security, sensors, connectivity. There's no doubt there's challenges ahead. Most of them said they don't really know how to go about it. The more developed, like Monsanto, Syngenta, they have their own venture arms. But that, again, that's very, very difficult to get into. Very, very hard to develop a venture business and start to invest and do it effectively. On the biological side, you can see internal R&D is becoming harder and harder, and this is just a metric showing the exponential cost increases over the last 30 years to produce roughly the same amount of patents and new compound approvals. So against this trend of rising R&D and the need to include digital data, we asked these companies, what are you doing at the moment? What's happening at the moment? As you can see on the column on the left, pretty much 2/3 of what they're doing is internal research and development. M&A activity is pretty limited, if at all. But when we asked them what is your preferred way to invest in agtech, clearly a different answer arose. The intention is to move into mergers and acquisitions, start to acquire the technology they don't have in-house, because they understand and they recognise that it's so difficult internally to develop this technology yourselves. By stimulating the environment for technology to be developed, we will see a lot more of this activity, and that is going to feed into technology innovation in Australia and globally. So I just wanted to finish with this headline. Anyone who thinks that agtech is dying or it's a flash in the pan, I would think again. This is clearly going to be an important aspect of what's going to happen for Australia, our market and our technology development. Being able to export that technology to countries like China, who have the capital, not necessarily the systems in place to develop this sort of technology. It's a great opportunity for Australia. So I would love to see us applying more money to the funding of these opportunities, more money for the development, seeing more technology come out of universities and be commercialised and actually end up in the hands of farmers. Thank you.